Despite recent outflows, bond funds are on track for record inflows this year, an estimated $130 billion as of November 14th. If the year ended there, that would be the largest annual haul ever for fixed income ETFs, according to ETF.com. I know, Dave, what's the bond breakdown telling us about what we should expect as we get into a new year?
Well, it's been really across the board. The big winners here on inflows have been international bonds, which I think has surprised people. BNDX from Vanguard, it's their global bond portfolio. There was no global bond ETF just a few years ago. That's pulled in $10 billion just by itself this year. But then once you get past that, it's really across the board. It's TLT, which is the long bond from iShares. It's Gov, which is a shorter maturity government bond fund. I see all of this as a safety rotation play. It matches nicely with the big flows we've seen into defensive equity plays like USMB from iShares and into gold. So I see all of this as maybe the beginning of a bigger rotation into risk-off assets. And with rates near zero, I guess that shift into income overseas, especially in emerging markets where the average yield is 5-6%, looks attractive.
Well, so the reach for yield is what lower rates obviously do to everybody. So if we look at whether it's the J&K and the HYG, or you look at the EM bond funds, some of the biggest ones, it's about extending out the risk curve. And as rates get this low, it's really going to be more about spread compression or spread widening. And I think that's where, as market prognosticators, we look at, to what extent is the credit market holding in here. And right now, if anything, credit has tightened a bit over the last couple months, which is very bullish. But I would extend what's been said. If you have the ability to invest in more sophisticated fixed income products outside of just U.S. Treasury curve, I think that's where the ETF world is changing and becoming, it's serving the retail investor in a way that, look, fixed income investors can do almost whatever they want in credit and in bond land and in muni land. And one of the things that we've learned is that this is where ETFs are starting to find enormous growth opportunities.
And Europe plays into this discussion as well, with the number of negative yielding bonds continuing to grow. We have a new ECB president, Christine Lagarde, but she is expected to continue what Mario Draghi put into place. Yeah, and that's the disconnect between retail investors looking at fixed income and, say, giant insurance and endowments looking at fixed income. They have no choice in some cases but to buy this negative yielding debt. No rational retail investor wants anything to do with this negative yielding debt. That's why they're looking at the long bond in the US. That's why they're looking at junk bonds in the US. And they're smart. They've been avoiding, to some extent, things like LQD, the liquid corporates in the US, because the spreads really aren't giving you that much reward for it. So I think bond investors are being very smart here. Tim, there was a note this morning from Morgan Stanley that says, now is the time to look overseas versus US. We've been having this discussion for a couple of months.
Time,
but going to 2020, does that trend continue?
I think so. And again, if the Fed is basically holding serve, and you have a dynamic where if we can get a trade deal done and you have the cyclicality, this does not mean runaway global PMIs. It doesn't mean that necessarily you get industrial production ratcheting up. You just need to stabilize. And for global markets and definitely emerging markets, the most money is usually made when things go from terrible to just bad. Right. And I think that's really what this dynamic is. But the rest of the world has outperformed. If you look at the DAX, and so the EWG ETF relative to the SPY, or if you look at the EEM relative to the SPY, look, emerging markets had been sending successive lower lows until the fall. And actually, you're 5 or 6% of outperformance since that point. Do you have a top market in 2020? In the EM space, I love Brazil because I actually think you have a currency tailwind from a central bank that's done a lot of fiscal adjusting. And I think, where emerging market central banks and treasuries do very well is an environment where inflation, the rest of the world is fighting to find some inflation. Right. So again, find the currencies that are the cheapest, find the industrial backdrop that I think makes the most sense. Stronger dollar, that always seems to be a longer term headwind for this space. Yeah, I mean, there's a lot of noise on the street right now about how that strong dollar can't last forever, but I haven't seen the crack yet that makes me think we should be running the other direction. Do you agree, Tim? Yeah, I think the dollar is the wrecking ball for global assets that usually comes when you have a flight to quality. So I think if we get a trade deal done and we find our way easing into Q1, Q2 of 2020, where the political dynamics don't change so much, I think the dollar is very range bound. I think we've largely been range bound for 2 years. Seeing the dollar begin to challenge, kind of 110 area, which is more a function, I think, of the euro and the politics across the European Union. That's what we should watch for, but it's certainly not my high expectation probability. Yeah, Lagarde has been calling for fiscal stimulus, but the Germans continue to push back. So that, of course, will be a key topic to watch into 2020.